Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Agco Corporation Annual Report. Agco Corporation offers a wide range of businesses and services to the agricultural industry. The company's product portfolio includes tractors for various applications such as row crop production, soil cultivation, planting, and commercial hay operations. In addition to tractors, Agco also provides equipment for harvesting and packaging vegetative feeds, including round and rectangular balers, loader wagons, self-propelled windrowers, and forage harvesters. The company's product offerings extend beyond tractors and harvesting equipment to include grain storage bins, seed processing systems, swine and poultry feed storage and delivery, ventilation and watering systems, and egg production systems. Agco also provides implements such as disc harrows, heavy tillage equipment, field cultivators, drills, planters, and loaders. Furthermore, the company offers combines for harvesting grain crops, application equipment for liquid and dry fertilizers and crop protection chemicals, and diesel engines, gears, and generating sets. Agco markets its products under various brands including Fendt, Massey Ferguson, PTx, and Valtra through a network of independent dealers and distributors. In summary, Agco Corporation provides a comprehensive range of businesses and services to the agricultural industry, including tractors, harvesting equipment, grain storage solutions, seed processing systems, implements, combines, application equipment, and diesel engines. Agco Corp's stock price has experienced a remarkable surge of over 44.75% in the past year due to a combination of positive financial results, strategic initiatives, and optimistic outlooks. One key factor was the company's strong Q4 2025 and full-year 2025 results, which exceeded analyst expectations with net sales of $2.9 billion and adjusted earnings per share (EPS) of $2.17. Agco also provided a positive outlook for 2026, forecasting increased sales and EPS. Another significant event was the company's ability to surpass Cone 2025 earnings estimates despite a decline in net sales. This demonstrated Agco's commitment to cost reduction and improved dealer inventory levels, contributing to an 11% rise in shares following the announcement. Additionally, the authorization of a $1 billion share repurchase program and increased full-year 2025 earnings outlook further boosted investor confidence. The collective impact of these events has been a significant increase in Agco's stock price, reflecting investor optimism about the company's financial performance and future prospects in the agricultural machinery and precision agriculture technology sectors. Agco Corporation market capitalization of $10 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Agco Corporation holds a significant advantage in their industry. Agco Corporation trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 2.43 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be multifaceted. One key factor is the impact of external market conditions, such as foreign currency exchange rates, which can affect sales and purchases. Additionally, fluctuations in steel commodity prices can also influence revenue. Internal factors also play a significant role in driving revenue growth or decline. Restructuring expenses and business optimization expenses can have a direct impact on revenue, with increased costs potentially leading to decreased revenue. Conversely, effective restructuring and optimization efforts can lead to increased efficiency and revenue growth. Interest rates can also affect debt issuance and subsequently influence revenue. Furthermore, return on net assets is an essential driver of revenue growth or decline, as it reflects the company's ability to generate profits from its assets. Geographically, significant revenue growth was reported in various regions, including Europe, the United States, and South America. Additionally, specific segments such as tractors, replacement parts, grain storage and protein product systems, and combine and application equipment experienced substantial revenue growth. In conclusion, a combination of external market conditions, internal factors, and geographical and segmental performance contribute to the primary drivers of revenue growth or decline for a company. The net income of a company underwent significant fluctuations between 2023, 2024, and 2025. In 2023, the company reported a positive net income of $1,171.4 million. However, this trend reversed in 2024 with a negative net income of -$424.8 million, marking a decrease of $1,596.2 million, -136.5% from the previous year. The following year, 2025, saw an increase in net income to $726.5 million, a significant improvement of $1.15 billion, plus 272.3%, compared to 2024. The profit margins also experienced changes across different product lines. Tractors and combines witnessed a decrease in profit margins from 61% to 66% and 4% to 2%, respectively. On the other hand, replacement parts saw an increase in profit margins from 13% to 19%. The company discontinued its grain storage and protein production systems product line. The reasons behind these changes are attributed to various factors. The significant loss in net income in 2024 can be linked to market conditions, competition, or operational issues. In contrast, the improvement in net income in 2025 is largely due to the sale of AGCO's ownership interest in TAFE for $260 million and the subsequent gain on the sale of the investment in affiliate. The changes in profit margins are also influenced by factors such as market share, sales decrease, or increase in demand. The company's ability to generate positive operating cash flow is a crucial aspect of its financial health. According to various pages within the extracted summaries, there are multiple instances where the company is reported to be generating positive operating cash flow. For example, on page 6 and page 36, it is explicitly stated that the company is generating positive operating cash flow. However, there are also instances where the opposite is true. On page 17, it is mentioned that the company is not generating positive operating cash flow. Furthermore, on page 88, the operating cash flow is reported to be negative at -$111,200,000 in 2025. This inconsistency raises questions about the accuracy of the information and the reliability of the sources. Despite these discrepancies, there are some instances where the company's ability to generate positive operating cash flow is confirmed. On page 58, it is reported that net cash provided by operating activities was $988.1 million in 2025, indicating a positive operating cash flow. Similarly, on page 60 and page 83, it is stated that the company is generating positive operating cash flow. In conclusion, while there are some inconsistencies in the information provided, it appears that the company is indeed capable of generating positive operating cash flow at certain points in time. However, further investigation is needed to clarify these discrepancies and provide a more accurate picture of the company's financial health. The company's debt level has undergone significant changes over the past few years. Initially, on page 33, we see that the credit facility was at $0, with senior notes due in 2027 and 2034, totaling $1.1 billion. However, by page 84, total long-term debt increased to $2.6 billion, while total long-term indebtedness rose to $2.3 billion on page 85. The estimated fair value of senior notes due in 2028 decreased from $703.8 million to $664.8 million, but the fair value of those due in 2034 increased from $700 million to $733.9 million. In terms of interest expenses, there have been notable fluctuations. Interest expense net decreased significantly from $93 million in 2024 to $66.4 million in 2025, as seen on pages 29 and 31. However, this decrease follows a substantial increase of 2,000% from $4.6 million in 2023 to $93 million in 2024, with a subsequent decline by 28.8% in 2025. Overall, the company's debt level has increased, while interest expenses have undergone significant fluctuations over the past few years. The performance of various regions and segments has been a mixed bag. On the positive side, Germany, France, Brazil, United Kingdom, Australia, Finland, and Canada have all performed well. These countries have seen significant growth in revenue and have consistently met or exceeded expectations. In contrast, Italy has struggled to keep pace with its peers, while North America has experienced higher losses on sales of receivables and poor performance in certain geographic regions. The region's issues are attributed to problems with volume discount and sales incentive programs. Looking at the revenue performance by region, North America has consistently generated the highest revenue, accounting for 94.9% of consolidated net sales in 2025. South America has seen lower revenue compared to North America, but higher than Europe/Middle East and Asia/Pacific/Africa. The latter two regions have struggled to keep pace with their counterparts. In terms of segment revenue growth, all four regions, North America, South America, Europe/Middle East, and Asia/Pacific/Africa, have experienced increasing revenue over the past few years. However, North America has consistently led the pack, with a significant increase in revenue from $1,045 million in 2023 to $1,234 million in 2025. The company has a strong outlook with plans to continue investing in product development to enhance the value of its brands. The use of trademarks such as Massey Ferguson and Valtra is expected to remain indefinite, ensuring brand consistency and recognition. Financially, the company aims to maintain flexibility through liquidity management and share repurchases, while also paying cash dividends to shareholders. The company's risk management strategy involves mitigating commodity risks through cash flow hedges and derivative instruments. This approach helps protect against foreign currency and interest rate fluctuations. In terms of investments, the company balances returns with risk control by diversifying its portfolio across various asset classes. Overall, the company's outlook is positive, with a focus on executing its business plan while managing financial and operational risks effectively. The company has made significant moves through acquisitions and divestitures. In terms of acquisitions, a notable partnership is the PTx Trimble joint venture, which began on April 1, 2024. This collaboration involves the integration of Trimble's agriculture assets and technologies into the company's operations. On the other hand, the company has also engaged in divestitures. A major move was the sale of the majority of its grain and protein (G&P) business in 2024. Specifically, this transaction occurred on November 1, 2024, marking a significant shift in the company's portfolio. The company's financial history reveals a commitment to returning value to its shareholders. One of the key ways it has done this is through dividend payments. The company has consistently paid dividends over the years, as evidenced by references on multiple pages in the report. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting stock price. Concerns about inventory buildup and supply chain disruption are evident in the industry. One of the primary concerns is the unpredictable demand and volatility in sales, which leads to higher inventory carrying costs and underutilized manufacturing capacity, page 10. This can result in significant and prolonged declines in performance during downturns in the agricultural industry. Furthermore, rationalization or restructuring of manufacturing facilities may cause production capacity constraints and inventory fluctuations, page 14. Additionally, system upgrades at manufacturing facilities could impact or delay production, while dependence on suppliers for components, parts, and raw materials can lead to adverse impacts on manufacturing costs and efficiency. The global supply chain is also vulnerable to disruptions, including labor shortages, inability to manufacture, and inability to sell to customers due to public health crises or pandemics, page 19. Increased governmental regulation of manufacturing operations and equipment, as well as climate-related changes and opportunities that may impact demand for products, further exacerbate these concerns. The data on inventory levels also suggests a potential buildup, with an increase from $1,187,900,000 in 2024 to $1,070,600,000 in 2025, page 81. This trend indicates that the industry is facing challenges in managing its inventory and supply chain, which can have significant consequences for business performance. That concludes the financial summary for Agco Corporation. Feel free to comment below, and I will be happy to answer them when possible.